Inflation is often described as rising prices, but that definition barely scratches the surface. Inflation is not just about paying more for groceries or gas. It is a silent force that steadily reduces your purchasing power, reshapes your savings, distorts investment returns, alters government policy, and quietly transfers wealth. Unlike an official tax bill, inflation does not send you paperwork. It does not announce itself with a due date. Yet over time, it can drain thousands or even hundreds of thousands of dollars from your lifetime wealth. That is why many economists call inflation a hidden tax. It operates in the background, but its effects are deeply personal and profoundly financial. Today we will talk This is how inflation is secretly taxing you. So before we start, make sure to hit the like button and subscribe to my channel. To understand how inflation secretly taxes you, we must first examine how it is measured. In the United States, the primary gauge is the Consumer Price Index, CPI, calculated by the Bureau of Labor Statistics. The CPI tracks the average change over time in the prices paid by urban consumers for a basket of goods and services, including housing, transportation, food, and medical care. While CPI provides a useful benchmark, your personal inflation rate may differ depending on your lifestyle. For example, if you spend heavily on healthcare or education, sectors that often outpace average inflation, your financial burden may rise faster than official numbers suggest. Inflation quietly taxes your paycheck by eroding real wages. Suppose your employer gives you a 2% raise, but inflation is running at 4%. In nominal terms, you earned more money. In real terms, you lost purchasing power. This gap between nominal and real income is where inflation acts as a hidden tax. It reduces what your money can buy without changing the number printed on your paycheck. Over time, this can shrink your ability to save, invest, or even maintain your lifestyle. Savings accounts are particularly vulnerable. If your bank offers 1% interest but inflation is 3%, you are effectively losing 2% in purchasing power annually. Even though your account balance grows numerically, its real value declines. This is why low-interest environments combined with moderate inflation can quietly transfer wealth away from savers and toward borrowers. Borrowers repay loans with cheaper dollars, while savers watch their cash erode. Central banks attempt to manage inflation through monetary policy. In the United States, the Federal Reserve plays a crucial role. By adjusting interest rates and controlling the money supply, the Federal Reserve seeks to maintain price stability and full employment. When inflation rises too quickly, the Fed may raise interest rates to slow economic activity. However, higher interest rates can increase borrowing costs for mortgages, credit cards, and business loans. That means your monthly payments may rise, adding another layer of financial pressure. Government spending also influences inflation. Large fiscal stimulus programs, such as those passed during the COVID-19 pandemic under the Joe Biden administration and earlier relief measures signed by Donald Trump, injected trillions of dollars into the economy. While these measures supported households and businesses during crisis periods, they also contributed to increased demand. When demand outpaces supply, prices rise. This dynamic demonstrates how policy decisions, though often necessary, can have inflationary side effects. Housing is one of the largest areas where inflation feels like a tax. Rent increases, and rising home prices significantly affect monthly budgets. Even homeowners are not immune. Property taxes often rise with home values, insurance premiums increase, and maintenance costs escalate with material and labor price growth. Housing inflation compounds financial strain because shelter is not optional, it is essential. Healthcare costs represent another inflation hotspot. Medical services, prescription drugs, and insurance premiums often increase faster than general inflation. Even with programs like Medicare for older Americans, out-of-pocket costs can climb. For working families, employer-sponsored insurance premiums may rise annually, effectively reducing take-home pay. This functions like a hidden deduction that grows over time. Inflation also affects taxes directly through a phenomenon known as bracket creep. In progressive tax systems, higher nominal incomes can push individuals into higher tax brackets, even if their real purchasing power has not increased. While tax brackets are sometimes adjusted for inflation, the timing and accuracy of these adjustments can vary. As a result, inflation can increase your effective tax burden without any formal tax hike. Retirees face unique challenges. Social Security benefits are adjusted annually through cost of living adjustments, COLAs, administered by the Social Security Administration. These adjustments are tied to inflation data. However, COLAs may not fully match the specific inflation experienced by seniors, especially in healthcare and housing. If benefit increases lag behind real expenses, retirees experience declining purchasing power over time. Investments are also impacted. Stocks historically outpace inflation over the long term, but short-term inflation spikes can create volatility. Bonds are particularly sensitive because rising inflation often leads to rising interest rates, which reduce existing bond values. Cash loses value outright. Real assets, such as real estate or commodities, sometimes provide partial hedges, but they carry risks and cycles of their own. Inflation redistributes wealth. Debtors often benefit because they repay loans with money that is worth less than when borrowed. Governments with large national debts may find inflation reduces the real burden of repayment. Savers, retirees on fixed incomes, and wage earners without strong bargaining power tend to lose. This redistribution occurs quietly and continuously. Global factors also influence domestic inflation. Supply chain disruptions, energy prices, geopolitical conflicts, and currency fluctuations all play roles. For example, oil price shocks can ripple through transportation and production costs, raising prices across industries. Globalization once helped suppress inflation by lowering manufacturing costs, but recent trends toward reshoring and supply chain resilience may change that dynamic. Education costs provide another example of inflation's hidden toll. Tuition and student loan burdens have risen faster than many household incomes. Borrowers may spend decades repaying loans, and inflation can complicate the equation. While loan balances may be fixed, wages may not grow proportionally, extending the real burden of repayment. Psychologically, inflation alters behavior. Consumers may rush purchases in anticipation of higher prices, which can further fuel demand-driven inflation. Businesses may preemptively raise prices to protect margins. These expectations can become self-fulfilling, embedding inflation into economic culture. So, how do you protect yourself from this hidden tax? First, prioritize investments that historically outpace inflation, such as diversified stock portfolios. Second, minimize holding excessive cash beyond your emergency fund. Third, seek wage growth through skill development, negotiation, or career advancement. Fourth, consider inflation-protected securities like Treasury inflation-protected securities, TIPS. Fifth, manage debt wisely. Fixed-rate debt can be advantageous during inflationary periods. Budgeting becomes even more critical in inflationary environments. Regularly reviewing expenses, identifying areas to cut costs, and adjusting financial goals helps maintain stability. Emergency savings should ideally cover several months of living expenses, adjusted for current cost levels. Retirement contributions should be revisited periodically to ensure they align with future purchasing power needs. Inflation may be invisible, but its effects are undeniable. By staying informed, adapting your financial strategy, and planning proactively, you can reduce its impact on your wallet and preserve your purchasing power over time. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.